Hey guys, thanks for joining for the October edition of SIH Capital Monthly Webinar. We have Andrew Cushman on today. Andrew's one of my, I don't know if you call mentors, but during COVID, Andrew had a mastermind course, and I was really fortunate enough to participate in. I was probably one of those best decisions of your life type of things when you look back at it. I always tell Andrew he put together just a wealth of knowledge, and then he also attracted incredible group of people. I still talk to a lot of those people today. So I'm always grateful for those connections and the knowledge that I gained from Andrew. He's definitely someone that I look at as a role model in this space. Usually, if you ever meet Andrew, if you meet an investor of Andrew's in any setting, the only thing that they'll ever say about Andrew is that, oh, he only 5x the deal. So they're always glowing praises, and usually investors can always find something to gripe about. But Andrew always has great updates, just great, genuine. He never oversells the deal. I'll never see a 20-30% IRR from Andrew's deals, and that's how I model my stuff because that's where I learned from. So Andrew, without due pause, thank you so much for joining. If you could just give a brief intro to the group, and then we could dive in.
Yeah, that was pretty good. Just, I guess, a little bit of the background is used to be a chemical engineer, went into flipping houses full time in 2007 here in Southern California. And then 2011 went full time into apartments, syndicated our first one out in Macon, Georgia in 2011, 92 units. And since then, done about 2,700 units, all in Florida. Now we're in Florida, Georgia. We also like the Carolinas, Eastern Tennessee, and a few submarkets of Atlanta. We did have 800 units in Texas. We got there before everyone else, thankfully, in 2012 and 13. But when everyone else showed up, we sold our stuff to them and went off and just focused on the Southeast. And then today, we're still trying to buy. It's really tough to get a deal to pencil out and put it together. But we are putting a lot of effort to trying to find good deals because while the next year or two might be a little more challenging, I think by the time we get to 25 and definitely 26, we'll be in another period of rent growth and increasing valuations. And the downturns is when the real money is made. You acquire good assets and you hold on to them for long enough. I've never met someone who bought a piece of real estate and held it for a long time and regretted it.
So the question I want to ask you on this is that your investment philosophy, you're not one of those, I would call them flippers that have a shorter time period. Of course, you're gonna sell if the deal completely makes sense. How has that been because that's now the catchy thing, because before that it was like, oh, you want to see those 1.75s and 3 year type of deals. And that was the whole rage and trend. But now that's shifted over where people want to hear the words long term. Like, how has your philosophy been pre interest rate hikes, and now how's your philosophy going forward?
Actually, it really hasn't changed. Most of our deals have always been a 5 year pro forma. About 20% of them have been 10 years. And we've got a couple that we were originally going to sell after 5 years, but none of our investors wanted to sell. So we still have them now, like 7, 8 years down the road. The reason that has been and continues to be our main strategy is the whole get in and get out quickly, like every 2 or 3 years. The benefits of it are it increases the velocity of money, meaning, like you said, hopefully if all goes well, you make 75% or something like that, and then you go do another one, generates a ton of fees and tracks transaction income. The problem is when the music stops, it all collapses. And one of the beautiful things about real estate is time is on your side. It's one of the few things in life where time really is on your side. And if you set up a property so that you have sufficient cash flow and your risks are mitigated enough that you can hold on to it as long as you need to, you're almost guaranteed to win. It might not hit your targets or something like that, but as long as you can hold on to it, it's extremely unlikely that you're going to lose money. So we've always been a little bit longer term because of that. And then also, a lot of our investors are not solely focused on, I call it equity creation. So if you're going to flip out of a deal in 2 or 3 years, you're hoping to increase the value, sell it, and get a profit. Most of our investors tend to be looking for both cash flow and equity. And the cash flow on value add deals really shows up starting usually the third year. And so that's why our typical hold time is 5 years. And again, we just don't ever want to be in a position where we have to do something in a 2 or 3 year period, whether it be refinance or sell or whatever. Because as we're now seeing, what happens if the market's not in a favorable condition, and now you have to sell or you have to refinance, right? If you can wait, if you have the option to wait 3, 5, or 7 years, then you can do that safely, and instead of being forced into something you shouldn't do.
So when you guys go into a deal, what's your like ideal debt that you guys place on a deal? Because that's been that's the crux of all the problems today, is because you got all the people that high leverage, and then on top of that, they did the variable debt, and that combination has been absolutely toxic in the last 18 months or so.
Yeah, our average loan to value on our portfolio, I think, is 42%. So up until about 20, let's see, when was that? Up until about 2020, we would typically go in with a 70 or 75% agency loan, or actually we even would buy all cash and then renovate and then just refinance into that. Once we got to 2021, we started going with more like 65% agency loan, because we were getting a little concerned about where the market was headed. So we dialed back the leverage a little bit. And then we do have some bank loans that were also 65 or 70%. Everything we have is fixed, except for one property that was floating rate, because there's some new construction that was part of it. And so that was the only option. But thankfully, we did buy a rate cap, and we got a 3-year term instead of 2. So we actually have a good amount of time left on that. So yeah, that was just our fault. When we looked at properties that we bought over the last 10 years, one of the first questions we always ask is, what is the greatest potential risk to blow this thing up? And most cases, interest rates are either the top answer or one of the top answers. And so we always hedged against that by either fixing or some other structure that made it so that interest rates couldn't cause a serious problem for us. And for the first 9 years, turns out it would have been fine, but it's good until it's not, right? And so now, and we question, man, because what happens is the people who are getting those floating rate short-term bridge loans, part of the reason they were doing that is because it made deals work, because you had high leverage, low interest rates. And so it was very hard for us to be competitive. And we second guessed ourselves a lot, like, okay, are we doing something wrong here? How come this seems to be working for everybody else now? And having that fixed rate debt from a few years ago is turning out to be a really good asset. And we didn't do as many deals, but we're thankful that the deals we did do are still in good shape. So
awesome. And speaking of that, you've been around for over 10 years, but I know from the mastermind and from conversations with you, you keep your team super small.
Mm-hmm.
Right. And I think I can relate to that, because I left my W-2 because I didn't always like the people who I worked with. And the more people that you're working with, the greater the chances you're not going to like working with someone.
That's true. Yeah.
Right. So what do you, in the last, let's say 24, 36 months, operators have come from teams of 2, 3, and now they have teams of 30, 35. What do you have any opinions on that? Like when you see that from your team perspective and you see such a large team, do you have like reservations when you see that from other operators as an investor?
Yeah, I actually do. And if you look at the operators who are currently imploding, it is the ones who basically showed up out of nowhere and rapidly scaled, just built a huge team, acquired thousands of units, and just grabbed everything they could and hired a ton of people. So that now the size of the team it's not an automatic. And there's guys, Ken McElroy's been doing this for 30 years, right? And he's got hundreds of employees. I wouldn't write him off just because he has a lot of employees. He's a very smart guy. But I would say anyone that either just recently showed up in the last few years, especially, and went from zero to a big team, it's not an automatic problem, but it would raise a red flag in that, okay, I want to find out what is leading to that kind of rapid scaling. Is it that they had, huge amounts of capital and insider knowledge, or is it just that they're buying everything that they can get their hands on? One situation is probably okay, the other one isn't.
Gotcha. Okay, cool. Always like to take the sentiment of another operator on something like that. Speaking of that, were you surprised? So one of the things that surprised me with these interest rate caps on these variable debts is how many operators didn't fully understand what the actual product was? Were you surprised? Is that something that you also gauged when you had conversations with them? Because from my understanding, people were selling this, oh, don't worry, we have variable debt, but we're fine because we have a cap, not understanding that it's an insurance product and it gets used up and then you have to refill it. And then that's what's really causing the stress on the cash flow and everything like that. Were you surprised, like, in now that you're looking back at it and saying, wow, like these people were taking these major instruments and really did not understand the product at all? Or just what's your take on that?
But yeah, risk can be defined can excuse me, risk can be defined as a lack of knowledge and control. And with the situation you described as a lack of knowledge. Yeah, what it is in one sense, it's not surprising because I wouldn't say there's necessarily a real estate bubble the last 10 years, but there was a syndication and money raising bubble. We had huge, you know how you have puppy mills? We basically had syndicator mills, all based in Texas, pumping out 1,000 syndicators a month and saying, we'll sign on your deals and just go do any deal. And I don't think that the education provided there was quite thorough enough to help people understand the risks that they were getting into, and explaining like how commercial loans are very different than residential loans, especially when you get into this floating rate stuff. And so what is amazing to me is I can understand, I don't think it's excusable, but I can understand those who got the loans not fully knowing how they work. They should have learned before they did it. But what I truly don't is just amazes me is the ones that have no caps at all. And I don't understand how someone could, number one, put themselves in that kind of risk, and then number two, how in the world a lender would have even allowed that, because those are loans that went from 2.7% to 9, and now the property can't even come close to paying the mortgage, and that's obviously that's not good for anybody. Yeah, it definitely the last few years raised a lot of eyebrows as to what was going on with some of these loans.
So speaking of that, let's say of the loans that are currently in trouble, every single other operator or every conference that I'm going to right now, someone will always have a slide and saying there's a record amount of debt coming up due, blah, blah, blah. And I've been seeing this slide from 2022, from like the end of 2021, and it just keeps getting pushed back and pushed back. I've had some personal experiences where not my loan, but I was trying to acquire a loan. And then when I've had conversations with the lender, they just admitted we don't know what to do in this situation. So there's going to be kicking the buckets. They're going to go deals in auction. What do you see to the people that are hearing, oh, the greatest deals are coming, they're right around the corner, whatever it is? What do you say when you hear something like that?
Like anything, it's a mixed bag, right? There's definitely some truth to that. We looked at a portfolio of 12 deals from one operator about 2 weeks ago. Every one of those deals was upside down, meaning in terms of they didn't have enough cash flow to pay the mortgage, and they were going to be lucky to sell it for enough just to pay the debt. So they're going to lose 100% of the equity. And like the offers we put in were actually below the debt. So in order for that to work, it's going to have to be a short sale. So those deals are definitely starting to show up. There's going to be more of them coming. There's been a lot of extend and pretend, people raising extra money just to pay the mortgage for a year. And it always takes a while for market, in this sense, seller mentality to catch up to where the market is moved to. So I do think there's going to be a lot more deals next year as more and more of these loans come due. However, couple mitigating factors is one, the banks that can do loan modifications we've already seen signs of them being willing to do that. So either they extend it for another year, they reduce the interest rate for another year, or do something to put the problem in the future. Another factor is I wish I was the only guy waiting for the deals and getting ready to buy them, but there's a whole lot of groups you may recognize, like BlackRock and others, who have billions of dollars who are just waiting for deals to start coming. And the minute one of those guys, the first one of those, that they start putting their toe in the water, that's going to be the green light, and then all that money on the sidelines is going to rush in. To me, this one of the main signs that we'll be at bottom is when you can buy a deal with agency debt at 70 to 75% LTV again. That's a sign that pricing and interest rates have basically come to an equilibrium where you can get standard debt. So, and then once that happens, I think it's going to be all in. The amount of deals, is it going to be like 2008, 9, and 10, where it's just like shooting fish in a barrel? I don't think so, but it'll definitely be more. The last year, volume's been only 20 to 25% of normal. And in multifamily, you typically, it's not like a single family rental where grandpa holds on to it for 30 years. Most of these things tend to trade every 3 to 5 years, maybe 7. And almost nothing's traded for the past year. So that doesn't take the deals permanently off the market. It just delays them. They will trade eventually. And yeah, I think there's going to be a whole lot more opportunity coming up in the next couple of years. I think it's going to be a great time to get started because there's going to be way less competition from other sponsors and syndicators and buyers in general. So there's going to be less competition. The deals are going to be better. And what you acquire the next couple of years down the road is, if you acquire the right property, you finance it, and you operate it, I really do believe it's going to be a good investment because there is a persistent housing shortage. It's about to get a whole lot worse, and that's going to set up the next cycle.
Andrew, speaking of, I just want to make sure I phrase this right. So speaking of today's environment, right? Like, I'm a firm believer right now is a great time if you could buy all cash, because you could almost guarantee, and it's different because I'm targeting deals of a much smaller size point than you. It doesn't make sense for you to do a $2-3 million deal. But in my boat, it does. And if I could raise all cash, I would be pretty damn excited because I know whether it's in 12, 18, 24, 36, 48, there's like a 99% chance I could refi out, right? This isn't like 2019 where you're getting sub 4 rates and saying, yeah, we're going to refi out so we could bump up the IRR. It's, if you're getting something in an environment of 8-9%, you're going to probably refi out in 3, 4, 5 years. What is your take on, does that get you excited when you potentially could do deals in today's environment, because that in 24, 36 months, it can provide for a substantial capital return?
Yeah, so we used to do that. We used to buy all cash, reposition, and then put a loan on it 2-3 years down the road and return 100% of investor capital. And then you're just, basically it's the Burr method on steroids, scaled up to however many units you're looking at. Yeah, we're really excited to be able to do that again. And originally said we'd do it and we return 100% of capital. The last few years, we'd be lucky to refi and get to 25 or maybe 30. So yeah, there's the opportunity is likely coming where you can either buy all cash, refinance, and then have no capital and therefore no risk left in it, or get it at an 8% loan. And you know what? If it works at 8% today, there's I'd say a high probability that I don't think we're going to ever see 0% interest rates in the foreseeable future again. But okay, if you can refinance into a 5 or 6 sometime down the road, that's going to really make that a good deal. And but the key is to set up your debt so that you have the option, so that if, let's say, interest rates go higher and stay higher for 10 years, the property you bought today at an 8% interest rate, you want to set it up so that it still works for you to hold it and exit it in that environment. However, if rates do come down, you want to have the option to refinance into something that makes it a better deal. You just never want to be forced to do something in the short term in case the market moves against you.
Got it. So 2 questions on that. Like, one, are you seeing, so one way to mitigate these high interest rates is to potentially get into a deal with seller financing, right? Just because the banks lend at 8, you could find a seller that, so like conversations that I've had recently in the last month, I put an LOI and I basically said, hey, you want a 5 cap? Good. Give me a 5% interest rate. So are you seeing that in the space that you guys are dealing with? Because broker deals, usually I never really see seller financing take a place, but I know you've done some stuff with Florida and stuff. I know you've done that in the past. Are you seeing any kind of openness on the bigger deals for seller financing?
Absolutely. Both assumptions, which is taking over the existing loan, and seller financing has become way more prevalent now than it was in the last few years. And that's actually, again, if those people who are listening say, I can't really do bigger deals or whatever, we did a $49.8 million deal with a big chunk of seller financing. So you just have to find the right buyer. Now, and especially the bigger you get, you're right, it's almost never advertised that way. The broker usually hasn't even had a conversation with the seller as to whether or not it's possible. And so what we do is, and now if we know that the seller is a syndication or they have no equity left because the value is gone, then seller financing, it's not structurally possible, right? But let's say you've come across a deal where maybe, a dentist bought it 20 years ago and he got this 20 unit property, he bought it 20 years ago, and he has 25% debt on it or something like that. That's a situation, whether it's brokered or not, where, and this is what we do, is we put in two offers. We say, look, here's a price free and clear to them, which means we're going to go get a bank loan, we're going to go agency debt, whatever, and that has a certain cost, and that means we can pay you whatever. So let's just say they're asking 10 million. We'll say, hey, if we go get a new loan and we do all this, we can give you 8 million. However, if you seller finance this at, let's say, 65% and 5% interest, we can give you 9 million, right? So we give them two offers, right? We want to show, hey, we're not dependent on seller financing just to get a deal done, but we can show we can pay you more if you're willing to do it. The Florida deal that we did was a $6 million seller financing at 0% interest. What we did is we structured it so we just make equity payments. So we're paying principal every month and that's it, no interest. And that saved that guy over $2 million in taxes. So that's another benefit to the seller financing. It wasn't just, we did get a great deal, but he also got a good deal out of it too. And if you can get in front of a seller and show them how that is, especially if they don't know what they're going to do with the money, it can be a win-win. They're going to earn a return. They're getting cash flow. They're not having the headache of owning the property. They're going to get depreciation passed through, depending on how you structure it, if you structure it as equity. And they're going to defer taxes, and you can pay them more. So there's a lot of benefits to it. The trick is getting that proposal in front of them and having that conversation.
Cool. And then I guess the other question in regards to interest rate and cap rates, right? For the longest, they've been lockstep, right? They were in the, let's say Class A was in the 4s and interest rates were in the 4s, right? They were in lockstep. Now you got interest rates at 7, 8, right? If an investor is looking at a deal and they see a 5 cap rate, 8% interest rate, is that an automatic huge red flag? What kind of correlation should investor from just a high level look at between cap rates and interest rates?
Yeah, cap rates have expanded or risen, but not in lockstep with interest rates. The two are correlated, but not one for one. So if interest rates go up, then yes, cap rates tend to go up, but if vice versa. But it's not, hey, interest rates went up 200 basis points, therefore cap rates go up 200 basis points. It actually doesn't quite work that way. If you're looking at a stabilized property, you're just buying it for cash flow, then your interest rate's higher than your cap rate, then you've got negative leverage, right? What does a 5% cap rate mean? Basically, it means if you bought the building for all cash for $1 million, then the net operating income is going to be $50,000 each year. So basically, effectively, it's called the capitalization rate, is that property returns your capital at a rate of 5%, right? It makes $50,000 a year on $1 million. So if you bought that all cash, you're gonna make 50,000. If you go and get a loan at 7%, that debt is costing you more than the property produces, and so it's negative leverage. So the only way that works is if you have a significant value add deal where maybe the cap rate is lower today than your debt, but you're going to do a bunch of stuff to it and the rents are going to be $400 higher. And by the time you're done with that, now the cash flow in the cap rate is much better than the debt that you had. That's the only way that buying with a cap rate below the debt, the interest rate on the debt actually works. Otherwise, you're just getting negative leverage.
Got it. Okay, so switching topics, because I know you talked about debt being the number one reason why deals go bad. I remember from your mastermind, I think the number 2 reason was insurance. It was either inefficient, a lack of complete insurance, or so insurance plays a monster role in these larger multifamily deals. Recently, all the talk, especially I think in the Florida area and other areas, insurance costs are like doubling, tripling. Have you seen that in your portfolio, and have you guys done anything to mitigate that?
Yeah, so I said that the first reason deals blow up is often debt. The second reason, or probably tied for first, is actually just inexperienced operators. But insurance can definitely be an issue, and insurance right now is one of the top reasons that new deals aren't penciling out. I'll give you an example. We have a deal in Florida. We're paying $800 a unit for insurance, and just off market, we let a buyer take a look at it, and they were getting quoted for 2,500 a unit, right,
Wow.
for their new insurance. So the worst insurance increases we've seen were in Florida. Our insurance went up 67% this year. And so when that causes a deal to blow up is if that deal was purchased on very thin margins where there's not enough cash flow to absorb a huge increase like that. And yes, you are correct. I've talked to operators, their insurance has gone up 2, 3, 4 times what it was, which is a massive increase. And nobody, myself included, underwrote that or thought that would happen or planned for it. Whether or not it blows up your deal comes down to how conservative were you, how much cushion did you have built into it, and how much cash flow does it have to begin with. Is it a leading factor in making, is that a sole factor in blowing deals up right now? Probably not. Is it hurting? Absolutely. But the biggest effect is really on new acquisitions, because sellers like me might be paying 800, but a buyer coming in getting a new policy might be looking at 2,500, and the seller doesn't understand or whatever, so it makes it really difficult. Now, if you go to markets like North Carolina and Tennessee that tend to not have disasters and are very landlord and insurance company friendly, then insurance is not as big of an issue and it's not as likely to go up as much. And then with all of that said, insurance, this has been a good hurricane season so far. We only had one, and it went into a pretty not populated area of the Florida Big Bend. And as long as we don't get another one before the end, again, it has been a good hurricane season. And right now, the insurance professionals that I talk with are expecting rates to basically stay the same next year and probably start coming down after that. Yeah, hopefully that situation is going to start to resolve itself a little bit.
Got it. So shifting gears a little bit, what is the general? I know you kind of network with a lot of different operators, bigger name operators that have thousands of units. What's the general sentiment when you talk to some of them on just where we are?
Depends on how their portfolio is doing. The guys that bought a bunch of high price stuff in 2021 and 22 with floating rate debt, all they're doing is they're just focused on maybe surviving. And so they're not looking at new acquisitions. They're just trying to survive, and some aren't. In terms of those who either have a stable portfolio now and or are in a position to look forward and acquire more, most of them are pretty actually excited is probably the word for it. That's been one of the most common refrains the last 6 years is, oh, can't get a deal. If you go on the Bigger Pockets forums, you go to a conference, that's what everyone's, oh, I can't get a deal. I can't get a deal. Now you're going to be able to get a deal. The problem is it's never easy to get a deal and to raise money at the same time. It's either easy to get a deal and hard to raise money, or easy to raise money and hard to get a deal. We've been in easy to raise money, hard to get a deal. We are transitioning to easier to get a deal, much harder to raise money, right? Because everyone does the opposite of what you should. When everyone should have been scaling back and getting more cautious the last 3 years, that's when everybody was throwing money at multifamily. Now, when everybody should start throwing money at multifamily, everyone's, I'm going to wait and see and not do anything. And that's the trick, is to do the opposite. Again, 2011, we had no competition. We were buying stuff for cash and at less than 10,000 a unit. We're not going to see those prices again, and if we do, I don't know if we'll have a country left anymore. So, but the opportunities are coming. Yeah, I'd say the mood is, again, it's bifurcated. If you've got a portfolio with a lot of loan issues, very pessimistic. But if you don't, and you plan on being in business for another 10 years, there's a lot of optimism, because this is the trouble we're having now, which is real, will set up the next bull market, the next cycle. So when we get through it.
That's exciting. Switching hats a little bit, from the operator side to the investor side.
Mhm.
Someone just starting and a limited partner, this is a really interesting environment for them to get started. And it's one thing to get started in 2012 and then never see a deal go bad. But if you've gotten started in the last 12, 24 months, I remember, right, capital calls used to be a sin. And now it's all capital calls. Okay, I had three last year. Like it's just it's almost okay. Cardinal sin now is commonplace. So this is a really interesting environment for a newer limited partner. Like, what would be your best piece of advice? And I know I'm not sure if you still do LP deals or you just do your own deals at this point. But if you were talking to a newer limited partner, what kind of advice? Let's say your son wants to, do some of these investments. Like, what would you tell them to look for in today's environment?
Geez, we could talk a couple of hours on that. Number one, you've got to vet the deal and you got to vet the sponsor. But truthfully, at the end of the day, the success of the investment is going to more rely on the sponsor than the deal. Any bad sponsor can take an amazing deal and run it into the ground, but a great sponsor can take an okay deal and turn it and either bring it or land it successfully or make it really good. So the key is really to vet the sponsor. And so what does that mean? Well, it's get referrals, and not necessarily referrals that the sponsor hands you. Go find your own referrals, right? So if you're investing with, a sponsor, go post in BiggerPockets forums and post on Facebook. Say, hey, does anybody know this guy? Has anybody invested with this guy? And find your own referrals. Second of all, in terms of the deals, look into what kind of assumptions they're making. Yeah, are the assumptions they're making for rent growth and insurance, are they more aggressive than what the market really is? I saw a deal a couple of weeks ago. They were projecting 7% rent growth for the next 5 years. I'm like, that's not very likely to happen. So look into the assumptions. Do they seem realistic? And really, I think one of the biggest mistakes LPs make is focusing on the projected return on the email blast or the investment summary or whatever. Generally speaking, the higher it is, either the more aggressive the assumptions or the higher the risk. If I see a multifamily syndication and they're talking about 18 plus IRR, that to me is a huge red flag. It either means it's highly leveraged, they've got really aggressive assumptions baked in, maybe a really low exit cap rate, so the whole deal works just because they're assuming they can sell the property at a much higher price down the road. So keep in mind, there's the whole phrase about if it looks too good to be true, it probably is. That's generally the case, especially now. If I see anything over 15% IRR, I'm starting to get concerned. Also, another one is if you see preferred returns that are greater than what the property produces, then that means that operator is raising extra money and then giving it back to you, calling it a distribution when it's actually just basically getting money from other investors to give it to existing investors, right? So what does that look like? That means when you get a deal and you go and you look at the financials and you say, okay, year one, this property makes 4% profit, but this distribution is going to be 7%. Wait a second, how does that work? It means that money's coming from somewhere and they're raising extra money to give it to you early. And you say, well, what's wrong with that? Number one, that's what Bernie Madoff was doing. And then two, what it means is that property has to be sold for a higher amount because when you raise extra money, you're pulling forward equity from the future valuation at sale. And if it ends up selling for not enough, you're going to have a loss of principal when that sells. So those are just some of the things to look out for. And I'd recommend a book to anyone who's going to invest as an LP. BiggerPockets published it. It was written by Brian Burke, and it's called The Hands-Off Investor. It's a bit intimidating. It's 350 pages, but read that book, and Brian did an amazing job laying out things to watch out for and how to calculate some of the stuff on your own so you can tell if someone's trying to pull the wool over your eyes.
Such a great book. When we first talked, I don't know how many years back, you gave me that advice on the preferred return, the look at it. And honestly, it was so rampant at that time. It has, I think there was a few SEC, from what I've heard through the grapevine, that there was a few SEC inquiries into the practice, and then it dramatically, like you hardly see that you see cash on cash much lower in the first couple of years by the same operators that were all doing those higher 7, 8, 9% cash on cash like a year earlier. So that's such great advice. Speaking of preferred return, this is something that we're going back and forth on is as you start doing deals, you realize that preferred returns can also really inhibit a deal from being a long-term hold, right? Because there's that catch-up period and I don't feel like it aligns with a longer hold. What is there any inkling on changing? I know some operators have gotten rid of it completely. What do you take to preferred returns?
Yeah, we actually got rid of them completely a few years ago because contrary to popular belief, preferred returns actually put the interests of the LP investors in opposition to the interest of the sponsor. And so you have a conflict of interest there that generally will can push the sponsor to make decisions that are not good for the investment of the property. And again, Brian actually addresses this thoroughly in that book. There's more on it in there. But basically what happens is, think of whatever that hurdle is. Typically, a preferred return is based on an internal rate, a hurdle of, 7% or whatever. And it's based on the IRR, internal rate of return. So the question you got to ask is, well, how can IRR be manipulated by a sponsor? They can get really high leverage. What does that do? That increases risk. They can refinance or sell early. That increases the IRR. So that's part of why you saw so many 2 and 3 year deals the last few years, is because the quicker you sell, the easier it is to hit the IRR. It doesn't mean your total return is actually that good. It just makes the IRR better. The reason being is that IRR factors in the time value of money. So the quicker you get paid, the higher the IRR. Again, doesn't mean you're getting paid more. It's just that IRR number goes up. And that's always the metric it's based on. So internal rate of return can incentivize the sponsor to, over leverage, sell when they shouldn't, refinance when they shouldn't. And then also, this didn't happen too often in the last 10 years because we were in a raging bull market and everything went great. However, let's say you've got a 7% return and we get into, a market like today where the interest rates goes up. Now the mortgage is higher, or maybe the rent's not increasing as much. And so now the property can't pay the preferred return. So let's say it's still doing okay and that property can pay 6%, but the preferred return's 7%. So what does that mean? That means the sponsor is no longer getting paid. So now you run into the situation of, okay, is your sponsor strong enough financially to continue to operate if they're not getting paid? Now, if it's 1 deal out of 10, yeah, they should, hopefully they are. But what happens if all 10 of their deals have preferred returns and the market has shifted like this, and now they're not getting paid on all 10? Do they have the financial wherewithal to continue operating and managing those deals? Let's say they do. Let's say they have the financial ability. Is that sponsor going to be willing to continue to operate those deals and not get paid for the next 2, 3, 4, 5 years, right? That hasn't happened. That wasn't really a concern, or nobody thought of that when rents were going up 8% a year for the last 7 years or whatever it was. But that's what's happening now, is a lot of these properties can't meet the preferred return, and all of a sudden the sponsor's not getting paid, and sponsor has to keep the lights on, right? So eventually, the question becomes, okay, if your sponsor is not getting paid, how good of a job are they going to be doing running that deal for you? So those are just some of the ways preferred returns actually put LPs and sponsors' interests at odds with each other and can really cause problems, especially in anything that is not a raging bull market.
And those are my feelings exactly, because it's 1 percentage point you fall behind a quarter and it starts looking like you can't get ahead of it type of situation. So that's where we've been heading towards, because we don't want to do 1,000 deals, but we want to do a few deals and hold on to them for a really long time. And that's exactly why we're thinking of also getting rid of preferred returns on future deals.
Yeah, and there's some LPs out there. It seems less and less, thankfully, but there's some LPs that, and it's actually more on the institutional side, that almost approach the sponsor LP investor relationship adversarially. Hey, I'm giving you money and you better pay me first and all this. You shouldn't be investing then if that's your approach. Your sponsor is your partner, and it's literally limited partner, general partner. The two of you and whoever else is involved are partners in the deal. You want to approach it with that mindset. Your sponsor should never be approached coming to this with a mindset of taking advantage of investors or anything but serving investors. And then investors should be approaching it like, okay, I am partnering with this person or this person's team for the next 5 years in this deal. We want to make sure that we win together, not just one of us. You don't want the sponsor to collect a bunch of fees and the investors make nothing, but you also don't want the investors to make everything and the sponsor gets nothing. Either one of those situations is unbalanced, is going to cause problems.
Yeah. And, as silly as it is, I still meet investors that confuse preferred return with cash on cash all the time.
That's another one. Yeah. Preferred return doesn't mean you're going to actually get it.
Yeah. It's just a benchmark. That's it.
Yeah.
Yeah. So that's something like when I talk to people and like, oh, I think our last deal preferred return 6. And then you have to like actually go in and actually explain to them that's not actually your distributions. And then that's why you can't compare it with someone else out there that has a preferred of 8, 9, whatever it is. It's not apples to apples. So the other thing, I think I should actually, you know what? We only have about 10 minutes left. So let me open it up to see if we have any questions. So if anybody has any questions, feel free to either put it in the chat or the Q&A, and I'll just pull them out. If not, I think we already have one. Andrew, how did you know to lock in fixed rates on your deals versus most other syndicators who went with cap rates instead?
You know what, Chris? I didn't know. I would be lying if I said that we predicted interest rates going up 500 basis points in 12 months. The reason we did it is because whenever we're looking at a deal, the first question we're always asking is, how could this go wrong? How could this lose money? And that eliminates a lot of deals. And then if we can mitigate all the risk, then we start asking, hey, what's the upside, right? So the reason that we fixed is we saw the biggest risk going forward was, what if interest rates shoot way up? We don't think they will, but if they do and we're not fixed, we're hosed. And we don't ever want to be in a situation where we're hosed. So we fixed. That was basically the approach. We knew it wasn't that we thought rates were going up this much. We just saw it as the highest probable thing that would kill deals. And so we wanted to take that risk off the table. And that's why we locked. Also, and we've talked about this a little bit, we tend to have a little bit longer view in terms of hold time than a lot of other operators. And we see, another way to eliminate risk is, if necessary, have the ability to hold longer. You can always sell sooner if you want, but have the ability to hold longer if things go wrong. So that's how we knew to fix rates. It wasn't that we saw this coming. It's just we saw this as a possibility, and you could say we got lucky or the whole market got unlucky, and thankfully we were positioned well for it.
Okay. Anybody else have any other questions? I'll wait until they pop up. I did want to ask, I think you were talking about fees when it came to preferred returns, of that balance between fair, like from the operator side to the investor side. Can you discuss what fees are fair, and then if you see other fees, which ones aren't at that point?
You froze there.
That was me? Okay, I think we could just start where we left off. So I was seeing if anybody else had any questions, but I did want to ask in regards to fees, Andrew, from a syndicator perspective, we probably on SIH, we really just do an asset management and acquisition fee. We don't really even do capital events. What do you see on, like, I've seen a recent deal and the fees were close to 10%. It was like an RV park. Yeah, I never seen anything like it. And then there was professional fees on top of that because one of the members was a lawyer. Like, it was extravagant. What do you guys see?
What you described sounds pretty crazy high. Although, and that sounds like a pretty extreme example. And that sounds like something I would probably avoid. However, with that said, the key thing to focus on is the returns to you, right? I'd be very concerned with the opposite. A sponsor that's charging no fees or very minimal fees and very low splits, because then I'm like, well, wait a second, where are they getting the money from? No one intentionally works for free. What's going on here? So I would get suspicious on either extreme. So the industry norm is for a multifamily syndication is an acquisition fee of, I'd say, 1 to 3% of the purchase price, depending on the size of the deal. So the bigger the deal, that at least if it's a smaller deal, it might be 3%. As the size of the deal goes up, it might drop down to 1. Asset management fee, 1%, maybe 1.5% is pretty normal, and that's 1% of gross collection. So if a property collects $100,000 a month, then $1,000 goes to the sponsor, and that's just covering overhead. That's definitely not a profit center. That is different than property management fee. For us, property management is 3%. That goes to a third-party company. A lot of operators will self-manage, and it's normal to see 3 or 4% getting paid to their management company. And let's see, renovation or construction management is typical. That could be anywhere from 3 to 6%. Capital events, refinance. I know that you see a lot of variability on that. What we do is we do a flat fee, usually $15,000 to $25,000, simply because it is really time consuming to get one of those done. So that's to make sure that we can pay everybody involved. That's usually what's typical. Maybe you might see a disposition fee, hopefully no more than like 1%. Sometimes loan guarantor fees. So someone is signing on the loan, especially if it's recourse, there's usually a fee paid to that person because they are taking risks doing that. So I think those are the normal ones. It shouldn't be too much else in there. And we got a question from Fabio. Want to go ahead and grab that?
Yeah. So are you still bullish on the same markets or starting to look elsewhere?
We're still bullish on the markets we're in. I would be careful with some others. I live in California because I enjoy the beaches and the mountains and the weather, but we do not invest here for a lot of reasons. We are still bullish on Florida, Georgia, the Carolinas, Tennessee, because of the, at this point, multi-decade long trends of population growth and job growth, and it's business friendly and landlord friendly. Texas, again, long-term, great story there. The markets to be careful on right now in particular are markets that have huge concentrations of low income C or D class properties, because those are the people that really struggle in a recession. And then also select markets where there's overbuilding. So Phoenix, Austin, Dallas, downtown Atlanta. There's a number of markets over the cross country that have a ton of new product coming on in the near term, like from now through the next 12 to 24 months. That will temporarily cause rent declines in those markets. Once that is over, then that might be a good time to go back into those markets, because assuming that the population growth and job growth is going to continue. So the number one factor when selecting a market to invest in is population growth. Everything else is secondary to that. You want to pick a market, whether you're investing yourself or through a sponsor, where there's good population growth and there's reason to believe that is going to continue. And then after that, there's a host of other factors. But markets, actually, so I'll say there's some markets that previously weren't too exciting, but are starting to. Just some Midwest markets that are actually still seeing pretty solid rent growth right now, because demand is solid and they didn't overbuild. Yeah, so it's constantly shifting thing to evaluate.
Interesting. So we had another question. The yield curve is inverted but headed towards positive. If the Fed doesn't lower rates next year, then it's possible for longer term rates to still go higher by a few percentage points. If this happens, then do you think the market will officially bottom then, or do you not care about this at all?
Oh, we definitely care about it. And you're right. The yield curve, which was extremely inverted at the beginning of this year, is approaching flat and may even revert back to a typical upward, from left to right, upward curve. However, there's a phrase in the financial markets called beware the steepener. It's actually a really dangerous sign when the yield curve goes from extremely inverted and reverts back up to an upward moving curve. And essentially, when that actually happens is almost always when the recession actually hits. So the inverted yield curve, meaning longer term rates are lower than short term rates, is a predictor of recession. When the curve gets back to flat or up, that's typically when the recession actually hits. So that is something we are watching. In terms of longer term rates, what is the effect of that? Most commercial mortgages are based on, not most, but many commercial mortgages such as Fannie Mae and Freddie Mac are based on the 10-year treasury rate. And if that continues higher, today it's like 4.9 something. If that continues higher, then that will continue to put additional pressure on commercial real estate. So yeah, that is something we're watching. My guess is, without some external event, I think the highest probability outcome is that the 10-year tops out around 5.25, and that would probably be the cycle high. There is a reasonable possibility that if it breaks, that it gets closer to 7. But with a recession probably coming, my guess is the 10-year tops out somewhere at 5.25. Again, that's not a prediction. That's what I see as the highest probability outcome. And yeah, it's absolutely something we're watching.
And I know you always post on LinkedIn. You're not very like flashy, but you like your charts.
I do, yeah. So I'm a former chemical engineer. I traded the financial markets, options, and all that stuff for 10, 15, maybe 15 or 20 years. Yeah, that's my background. I love all that stuff.
Got it. Okay, so I think we are officially at the 1 hour point. I know we started a little bit late. If anybody has any last question, feel free to throw it in. But Andrew, I just want to be respectful of your time. As always, just tons of knowledge, and always enjoy talking to you.
Yeah, it's good connecting, Dennis. And as you mentioned, I do post a couple times a week, usually on LinkedIn. I'm not on any other social media because I'm not into selfies and dances, and I don't have anything else to sell. But the stuff I post on LinkedIn, that actually is me, and that is actually me replying to the comments. If you would like to have further conversation, that is probably the best place to do it.
And Andrew, can you just where your company is, and if people want to be added to your investor list?
Yeah, it's Vantage Point Acquisitions. The website is ACQ. I think I can type it in the chat, right? Let me do that. VPACQ.com. And yeah, there's a connect with us button there. Did that show up, Dennis?
It disappeared. Oh, because it shows up as answered.
Oh, I see. Gotcha.
I'll just put it in the chat. Hold on.
Yeah, I'll put it in the chat. Let me do that. Yeah, so Vantage Point Acquisitions, VPACQ.com. There's more about us there. There's a way to request to potentially be added to the investor list. We do a quick short form and a quick interview first. And then, yeah, look forward to hopefully connecting with y'all on LinkedIn. And I think there's opportunity coming. So choppy waters to navigate, but that's when you find the good stuff.
Thanks. That's a great way to leave it off. Thanks, Andrew. Enjoy the rest of your night.
Have a good evening.
Thanks, everybody joining in.